Okay, hey class, today we're going to talk about Chapter 17, Understanding Accounting and Financial Information. We've jumped into Part 6, which is Managing Financial Resources. Very important, obviously, for getting yourself together with funds for your business. All right. Couple of jokes for you right there, but what I want to say about accounting is it is a universal language. It is a language that works for the smallest of small businesses all the way up to the biggest Fortune 500, Fortune 100 companies in the world. Everybody does it the same everywhere. It's a language that works for the smallest little dog groomer to the biggest oil companies or Google or most giant firms in the world are all doing the same thing. There's a process, there's a way to do it. One and only one way to do that. Now, the reason why it's important is because, for example, 10, 20 years ago, Enron, the big scandals with financial accounting, people cheating on financial accounting. How do you know if you're investing in a company that's going to be good if they're cheating on the books? It ruins investments. Nobody can have faith in anything, so you have to have faith in the business that you're investing in, and the people that are working in the business need to have faith that they're counting all the money. So the good part about accounting is that the careers and the advancement through the system is fantastic. You can do very well with accounting in your career. So let's get right to what this accounting is really all about. It has to do with bookkeeping. The difference between accounting and financial planning is important. Accounting is counting the money, counting inputs, seeing what sales, what revenue is coming in, payroll, bank records, all that kind of stuff. That's accounting, counting the money. Then we have to take that transaction and put it into something. Typically, we call those T accounts. Take an accounting class and you'll understand about T accounts where you have debits and credits. Don't have time to go into this, but you're putting journal entries together and you're classifying this. So if you're putting expenses towards a vehicle, putting expenses towards cost of goods, inventory, petty cash, whatever it is, you know what you're doing. And then the outputs are these financial statements that you're getting, annual reports, and balance sheet and income statement is what we're going to talk about mostly here, is balance sheet and income statement. The interesting responsibilities that accountants have is really full spectrum. Every part of the business needs to understand where the numbers are going. The CEO of the business understands, and the CFO, Chief Financial Officer of the business, those are the ones that have to know what's going on. Think about what you're doing. You have to manage your cash. You have to consider marketing, planning for marketing. You have to talk about financial planning, valuation of mergers, acquisitions. Maybe you need to buy a new plant, expand, contract, and then look at all the time that needs to be spent in auditing and taxes. Taxes are something that often is done separately, but it certainly takes a lot of time and effort from things. Next, we've got there's some steps in the accounting cycle. Sorry, I'm missing some of this here. I'll try to move the camera around a little bit. Like I said, we take the documents in, we record them in the journals, and we post them to the proper ledger, and we balance out and make sure that our numbers are correct. Again, take an accounting class and you'll understand how that works. And then the financial statements that come out would be balance sheet, income statement, statement of cash flows. And what the CEO and CFO are going to do after all this is done is they're going to analyze. They're going to sit down and they're going to say, okay, what are we doing right? What are we doing wrong? If you don't know that, you can't run a business. If you don't know what you're doing with your money, it's hard to run a business. The next thing that we're looking at is, there's three main financial statements, and these first two, balance sheet and income statements, are the most important, and we're going to talk a little bit about those. First, the balance sheet. Think about it. It's balancing the sheet. It's taking what do you own in a business, what do you owe, how much have you put into the business, how much have stockholders put into the business. That's how much the company is worth. So then here is the accounting equation, which is, you've probably heard this before, assets equals liabilities plus owner equity. Here are your assets. This is what you own. This is what the business is worth. That's an important thing to know. How much are you worth today? Have you built profitability? Have you built a bunch of trucks and plants and things like that? Those are all assets. Sometimes the way in which you go about building those is by taking on debt. That's what liabilities are all about. All the debt that you take up to build the business. If you buy a truck, you don't have to pay for it all at once. Usually people don't. Pay for it over time. Large loans, it's paid off over time. And then, of course, the owner equity is what you've put in. Maybe if you have partners, if you have stockholders, shareholders, they're pouring money into the business just like liabilities or debt is going into the business, buying things such as assets and inventory, and they should equal. You can't throw money at something and not count for it. Again, there's generally accepted accounting principles that are done throughout the world. Everybody understands how that works. So this is the balance sheet, very important. Balance sheets are, like I said, they're the same for the tiniest dog groomer all the way up to Ford and Macy's. And then you know where you're at with the balance sheet. A balance sheet, let me just say that the balance sheet, I want you to look at figure 17.4 in the textbook, and it shows you what a balance sheet is all about. You'll see at the top all the assets. This is what we own. This is what the business is worth because we borrowed this much and we put this much into it. A balance sheet is a snapshot in time. Count the money, count the inventory, how much you got. It's a snapshot. December 31st, the end of the year at midnight, you count the money, see what you got. This is what the business owns. You can take a snapshot at the end of every month and say, here's what we have. But typically quarterly, yearly, you take a balance sheet and you take a look at it. Any business that is publicly traded, you can go in and take a look at their balance sheet. So let's move on to the next part is the income statement, is the financial statement of profits and losses. Is that an important thing to know how much you're making? Yes. Income statement covers a period of time. What you make from January 1 to January 31st. That's an important thing to know. How was your month? How was your first quarter? How was your first 6 months of the business? How is your year coming out? That's what it shows. Here's what you earned. It cost this much money to do that. So there's another illustration, figure 17.6 in the book that you want to make sure that you look at that. Again, these are pretty basic, simple formulas that if you understand why the formula is being put together, you understand how this stuff is being done. Here's the income state formula. Take your revenue. How much money did I make selling my widgets from January 1 to January 31st? I sold $10,000 of widgets. Each widget cost me $2 to make, so I spent $2,000. That's cost of goods. There's gross profit. I made some money off of stuff I bought. That's gross profit. Very simple. How much did it cost me to make that thing or sell that thing? Did I have an office? That's operating expenses. Operating expenses can be rent, office, loans, the expenses that it takes to build the business, to maintain the business. And then you have a net income after that, and then Uncle Sam wants his due tax money. So once you've figured out all your expenses, pay the government, you've got some profit, you take a percentage of that and you pay the government. That's the income statement. Here it is. Revenue at the top. Everything received from goods or services or anything that comes in. Cost of goods. It costs you money to do that, and you come up with profit, gross profit after that. Other things, operating expenses, rent, utilities. What does it cost you to do that? You can't overlook that, and you have a period of time in which you had the rent, salaries, your salary. Depreciation is where you write off the cost of goods. For example, you have a truck. It should last 10 years. Each year it's worth less. You've worn out the truck 1 year, so it's worth less, so you can depreciate that. You take that as an expense. You've used the truck in its lifetime. The third important financial document is cash flow, statement of cash flow, or cash flow management. And I'm not going to go into that. But basically, here's the question. The CEO and the CFO need to know what bills are due, What's coming up? Imagine payroll's Friday. Does the CEO on Monday not know if he has enough money? No. CEO and the CFO and all the people in financial management know that there's enough money to pay employees. How about bills that are coming due? CEO knows I got 30 days on this one. It's due in 20 days. I got to have the big payment for that one. So that's the management of cash flow. Cash flow is one of the toughest things that businesses have, large and small. All businesses have tough challenges with cash flow, because think about if you don't have enough money to pay your vendor, or if you didn't manage your money right and you couldn't meet payroll at the end of the week. What happens when you miss payroll? You quit. I would quit. If the company is not paying its people, you can't do that. When people start quitting, the company's falling apart. So that's the importance of good cash flow management and how that works. Another part of the book talks about ratio analysis. A ratio is the relationship of one number to another. Or how much did we make? How much did that cost us to make? Or how much did we sell and how much inventory are we setting on? Or how much do we turn our inventory over in a period of time? Or how much debt do we have? Is that normal among other businesses? Is that costing us a lot? This type of analysis is the highest paid analysis in the business world. You could get a job working on Wall Street and analyzing businesses and make $10 million a year doing this type of ratio analysis. It's that useful to a business. Maybe the CEO doesn't really understand how much profitability he's getting based on how much labor he's using. And if he can tweak that a little bit, it will help his profitability. How valuable is that for somebody to understand? So ratios are really important to understand how the business is running in relationship to another number. Lots of different types of ratios, and they're all important. Take, for example, inventory for restaurant tables. It's a service. You have inventory. You have so much space to feed people. It's an interesting part of today's society is we've got that inventory of space that we have to manage. So those are kind of important things to understand. So that's my my stuff for chapter 17, and you're going to try to put together a financial draft. Remember, it's a draft. A draft is a first practice. Use outline format. What do you need for marketing? What do you need for operations? What people are you going to have? Just put that down on paper, and that'll help you out a lot. Okay, thanks very much.